Good day, I'm Marius Cornelissen from PSG Wealth Menlyn, and it's time for our quarterly market view. The news cycle over the last 3 months has been dominated by COVID-19 again, but mostly in China. In most places in the world, COVID is starting to slowly go away, but in China, they went from severe restrictions to almost no restrictions overnight. Inflation has also dominated the news cycle, with climbing in a lot of places in the world, but it seems to be slowly ebbing away. Elon Musk and his takeover of Twitter has also set tongues wagging, and then of course Kevin McCarthy took over as Speaker of Congress, with the Republicans taking back control of the House of Representatives in the United States. Global inflation, well, it seems to be heading down. If you look at this chart on the left-hand side, you can clearly see that inflation has peaked in the United States in June and is now slowly starting to drop away. It should accelerate in the coming months, which is good news for interest rates. Also in South Africa, if you look at the chart on the right, you can see that over the last 4 months, monthly inflation has been really low. This trend is bound to continue, and inflation should come back in the next 6, 7, 8 months in the Reserve Bank's target rate. Interest rates have increased also in the US, Europe, England, as well as in South Africa. The Fed has kept pace with inflation going up, but they're still looking to increase rates a little bit more. In South Africa, the South African Reserve Bank has also increased rates steadily, and in all fairness, it seems like 1 or maybe 2 more rate hikes might still be on the cards. Brent crude oil has been one of the main drivers of inflation. However, we can clearly see that since those peaks that we saw in the middle of 2022, Brent crude oil has slowly started drifting down and is now back at $80 a barrel. Why is this important? Well, it's now lower than it was 12 months ago and quite a bit lower than it was before the Russian invasion of Ukraine. Food prices has also continued its drop. The United Nations Food Price Index is still going down at a significant rate, but it's still elevated compared to the levels of 2020 and 2021. This is, however, good news, as food has been one of the main drivers of inflation globally, and lower food prices will, at the end of the day, help to bring inflation and thus interest rates under control. Natural gas prices have plunged. We've seen natural gas playing havoc in especially Europe, especially in the United Kingdom, as well as in other countries like France and Germany. They've had a big problem during the course of last year with natural gas prices increasing exponentially. However, since those peaks in September, the price of natural gas has come down a lot. There are a couple of reasons for that. First of all, there's been significant adjustments in supply. We've also seen that there seems to be enough natural gas currently available. And the other thing, of course, is it's been a significantly warmer winter in Europe than anticipated. With all of this, we've also seen the rand fighting back against the US dollar over the last few months. The rand weakened to levels of about 18.50 against the US dollar in October and November, but subsequently it's been strengthening and it's around about 17 rands against the dollar right now. If one looks at the purchasing power parity index, the rand should be trading at more or less 15.50 rand against the dollar. It could well strengthen to those levels in the coming year, although we still have some other factors, especially Eskom and the water situation in South Africa, which could impact that. Looking over at markets, it seems that China has been waking up of late. Chinese stock markets have been horrible over the last year, but since November, it seems to have picked up quite a bit. The Shanghai Composite on the right has increased by 10%, but the big move has been on the Hang Seng, where Naspers, this is one of the investments, Tencent, is listed. Well, the Hang Seng, as you can see, has gone from about 15,000 on the index to over 21,000. So that's been an incredibly strong recovery that we've seen on the Hang Seng, and we can see that also in the recovery that Naspers has shown on the JSE. Over the last 3 months, the JSE has also increased quite a bit, led by Naspers and the commodity shares. From a level of around about the middle 60,000s, the all-share index has gone up to about 78,000. So it's been a strong quarter for the local market. The Dow Jones Industrial Average in the US has also recovered from the lows of September, but it seems to be treading water at this stage. Now, it's very easy and very simple to blame this on the technology shares, because if one looks at the technology shares on the screen right now, you can see that Amazon over the last year has dropped by 45%, Tesla by a magnificent 66%, and Meta, the owners of Facebook, has also dropped by 60% over the last year. A lot of billionaires are still billionaires, but they're not that big billionaires anymore. But it's not just been the technology shares that have led the decline on US stock markets. In fact, if one looks at some of the other components of the Dow Jones, and these ones are just 8 of them, you can see that it's been more broad-based. Big industrial companies like 3M has dropped by 28%. Banks like JP Morgan Chase and Goldman Sachs are also doubled down with double digits. Home Depot is down 17%. The telecom company Verizon dropped by over 21%, and American Express down by 13%. One of the big losers, however, was Disney, which dropped by over 40%. So it's not just as simple as technology shares being weak, it's been more broad-based in the US stock markets in general. We've seen and we've heard a lot about people saying that 2023 is going to be the year of the global recession. Recessions are predicted in most countries in the world, although we in South Africa might well not experience one. However, is it as simple as a recession and weak stock markets? We've spoken about it in the past, and no, it's not. If one looks back at this chart that looks at the S&P 500 in the US and recessions, you can see that in not all recessions, from the start of the recession to the end of the recession, you see the stock market ending lower. In fact, quite a few of these recessions had the stock market increase over the period of the recession. The S&P 500 is also now 18% lower than it was in December 2021. So a lot of that has been priced in already. In fact, if one looks back at September last year, the S&P 500 at that stage was almost 25% below the peak already. So that was a bear market that happened before the recession. One has to remember that stocks usually decline most before a recession hits, and stocks are sometimes up during a recession. One of the things that often happen is that stocks recover before the recession ends. We usually see that. And their average return 1 year after a significant drop is a lot higher than the average. So what does this mean? It means that if one looks back at similar circumstances that we're seeing right now, high inflation, high interest rates, when last did we, and then of course a recession, when last did we see that? The last time that we saw something similar in the US was in the 1980s. At that stage, Ronald Reagan became president, inflation was a problem, and interest rates increased. Yet, despite that, and despite the Fed fighting inflation with everything they've got, we saw strong increases in the S&P 500 during those recessions. So there's ample reason to believe that we've already seen a bear market, we've already seen a drop, and similar circumstances in the past, we've seen increases in stock markets. So that doesn't necessarily mean that a recession will lead to declining stock markets. To almost end off, what keeps me awake at night? Well, the war in Ukraine is still going on. China and Taiwan seems to, we're seeing a lot of flights from China going over Taiwan. That becomes a problem when somebody starts shooting. Global central banks, of course, we've spoken about this as well. They might overshoot with interest rate hikes, although the language from the Fed of late has been a lot more moderate, and it seems that they're seeing that inflation is starting to get under control, but they will probably hike once more or maybe twice more. A deeper and longer recession could also happen, but then something else needs to happen, like for instance a war between China and Taiwan or further escalation in the Ukraine war. Locally, corruption, Eskom, water, political instability, unemployment and crime well, that's still factors that are in play that could specifically impact local shares. Again, what gives me hope, there are still opportunities given the markets that are weak, especially overseas, although we've seen that the local markets have done well. The rand should be stronger going forward. Fair value should be closer to 15.50. It's not necessarily going to head there, but it might head closer to that than to 18. All of this, if the rand strengthens and if Brent crude oil keeps at the current low levels, we will see even lower petrol prices. We're already looking at significant drops in the price of petrol and especially diesel heading our way in February, and that will be really good news for motorists. We will also see lower or stable food prices. Now, food prices don't just easily drop, but they might remain stable for longer. That's also going to be good for inflation. These things should lead inflation to moderate. And if that happens, interest rates cuts, well, could happen sooner rather than later in South Africa and Europe. And also, if a recession hits, you could also see central banks being pressured not to increase interest rates even further. That should all be good news for stock markets. We should also use, if there is a recession, if there is volatility because of that news, we should use that to find value in the market. You get distortions when news flows happen, and those distortions present opportunity. China is also moving away from a zero COVID strategy. That should be good news, especially for commodities. And in South Africa, we will be one of the main beneficiaries of that. At the end of the day, be realistic, diversify, and then everything will be okay.